We're here to talk about Silicon Valley real estate market conditions for October the 5th. This is the graphs that we're going to be going over. Here's a quick summary of them. You can jump to whatever section you find most interesting for what you're doing. But we're going to start off with the key market indicators. Then we're going to look at active compared to the 10-year medians. Then we're going to look at Silicon Valley performance, which is all the metrics compared to their 10-year metric. And the 10-year metric is the 10-year median for each of the individual times. Then we'll look at the three distributions. Then we'll get down here and we'll look at the three counties compared to themselves. Then we'll finally get into the heat maps, the summary of the heat maps, the raw data for those that like it, and how to participate and get the handout, which is up. I would appreciate it if you like each episode that you watch and then also subscribe once. And then we'll finish up with the Greater Bay Area, which is 5 regions in Northern California. I brought this slide up and it's a one-off, and it's just to show you the importance of understanding statistics. Statistics, you can say anything you want to say. This is the appreciation chart. Basically, the concept here is the same. Red favors the seller, blue favors the buyer. And what I really want to point out is coming down here to Alameda County. Alameda County overall has had a 70% appreciation, but you really, when you look into the micro market data, which is why it's so important, you have two of the micro markets, Fremont, Union City, and Newark, that have the highest appreciation rate at 93%. But you also have the lowest in Oakland, which is a huge area as far as the number of transactions at 38%. And then you also have weighting them down Berkeley and Alameda at basically 58%. When you put this all in a blender, Alameda County comes in with below median appreciation at only 70%. But the range is from 38% to 93%. And if you didn't have that micro market data, you would have no way of knowing this kind of data. That's the importance of it. And if you looked at just the appreciation at 70%, you would think that Alameda County is underperforming. Overall, Alameda County is absolutely on fire, except for two of the regions. And one of the regions, Oakland, happens to be the biggest area. Rough numbers, 750 transactions, and 250 of those transactions are in Oakland. So Oakland is 1/3 of all of Alameda County, even though geographically it's a small fraction of that. So that was just the point I was trying to make. You have to understand what's behind the data. Here's the first normal chapter. And what we're doing here is we're looking at the normal market, which is the thin gray line, the purple, which is actually the raw data for the current year. Red is the hottest you'd expect the market to be, and blue is the coolest you'd expect the market to be. And cool with inventory is a lot of inventory. And what you're seeing is we've had a shortage of inventory. We started off the quarter at 81% of the normal inventory you'd expect at 2250 active listings. That active listings has now grown up to 2652. So you've had a growth of 400 listings, but listings normally grow. So you've only gained 10%. So we still have a shortage of listings, but the shortage of listings now is only at 10%, actually only 9%, versus being at 19%. So that's a huge improvement on buyer availability of choice. Offers accepted, you can see we've been basically down at or below the least number of offers you'd expect. Only this last week have we come up a little bit above the least you'd expect. We're still way below the gray line, but the gray line normally decreases at this time of the year. At the same time, the purple line has basically been flat. You've gone from 2143 transactions to 2130, and that's pretty flat in terms of statistics. So that's led to an improvement from 76% of the offers you'd expect to 83%. So we're still missing 17% of the transactions in the industry. Days of unsold inventory is the turnover rate of the marketplace. You've gone from 37 days, which is 110%, to 45 days. So you've had a much slower marketplace by about a third almost, but yet you've had an improvement to 98% because an improvement on DUI is a faster turn rate. And so now you have the normal turn rate versus a slower than normal turn rate, even though the market has slowed considerably. So the market has slowed, but hasn't slowed as rapidly as it normally does. therefore leading to an improvement in the marketplace. And we'll see the same thing on days on market. This is the time it takes the typical seller to sell. The typical seller is the 75th percentile. They were taking 21 days, which was 18% longer than normal. Now it's at 26 days, which is clearly longer. It's almost a whole week longer, but yet that's completely normal. So there's been an improvement in the time to sell your home. Price reductions. We've gone from a 0.8% price reduction, which may sound completely trivial, but as I've said many times, the number of sellers that are reducing their price is pretty small. So that's actually a 21% greater than normal price reductions at 0.8%. And now you're at 0.9%, which is only 1% greater price reduction than normal. So you're essentially at normal price reductions as far as the magnitude. And then we jump down and we look at overbidding, and this is buyers' competitiveness when they submit an offer. And we were at 7% overbidding, and this is average overbidding, and we'll talk about median later, but this is average overbidding of 7.7% above the seller's ask price, which is almost a full percent above what it typically is. And that's why the purple line is above the gray line on the red side. Now you're 1.2% above normal, even though the amount of overbidding is only 5.7%. If you come back here, the normal amount of overbidding would be 6.8%. The normal amount of overbidding now is only 4.5%. You have to keep in mind what the market typically does, because real estate is very cyclical on an annual basis as well as a weekly basis. Now we're looking at the three components. The purple line is simply the inventory. So you can see we're about 91% of the inventory you'd expect for this time of the year based on the last 10 years. And you can see there's real, when you look at the purple line up here, from 2014 through about the pandemic, we had a surplus of inventory most of the time. Since the pandemic, we've had a shortage of inventory compared to the 10-year median. As we get further along in 2026 and 2025 and 2027 and 2028, this historical data here will come out of the 10-year median. In fact, pretty soon, in a couple months, we're going to be losing this 10th percent here, which is a pretty high 10% as far as inventory is concerned. And so we're going to all of a sudden look a lot more normal. Now, moving on to offers, which is the gray line up here, it's essentially at normal. You're maybe 98% of where you'd expect to be. And again, it spent most of its time pretty close. Yes, we had some hot times down here. We had the slowdown in 2022. So you've had swings, but in general, the gray line, which is the turnover rate of the marketplace, stays pretty close to typical. And that's because if you have a lot of inventory, buyers come out. If you have a lot of offers, the sellers come out to make up for that. So you tend to go back to 100%. And then finally, you're looking at the number of offers, which is the orange line. The current number is 83%. So you can see you have a shortage of offers compared to the inventory. And the reason the DUI is, the turnover rate is so close to 100% is the number of active listings and the number of offers happen in different years. And I actually had a table, but I'm not going to show that yet. And if I have time, I'll bring that up at the end. Here's your 10-year median. So now the gray line is exactly where you'd expect the market to be in a typical year. And again, that's based on the years 2014 through 2023. And then the purple line is where the data actually is. So you can see the purple line is rolling over as you would expect it to do based on the gray line. And now you expect this trend to continue, and you expect the availability of choice to rapidly decline. So basically, in just a couple more weeks, we're going to be somewhere down here, and we're going to have 20% less choice in the marketplace. Here is the pulling out that gray line that was curvy and making that 100%. And you can see right now we're somewhere around 91% of the inventory you'd expect it to be. And also what's somewhat interesting is if you come back horizontally, we basically have the most inventory compared to normal equal to or above the level of inventory we've had for the last year and 3 quarters, all the way back to about February call it Valentine's Day of 2023. So for the last year and a half, buyers have never had as much choice as they have now compared to what they normally have at that time of the year. Here's the number of offers. And again, here you can see the purple line has been at or below the blue line, which is the least you'd expect. So we clearly have a shortage of offers. And again, you have the same thing that you have with inventory. You come back at the early time frame and you were basically at the normal level of offers, which is a higher level than we are at now. And then you had a surplus here after the pandemic. So the number of offers is not going to drop as dramatically as the number of available listings that I expect that we'll actually start seeing that impact just even next year. Here is the low inventory. You can see that it's been slightly on an upward trend. If you look long term, the trend might be something like that. We currently have a spike, but that spike has rolled over. Is it going to come back down to these low levels? Will come somewhere in between. When you're comparing it to normal, there's no way to know what that's going to be. Here's the turnover rate that is measured by days of unsold inventory. You can see the purple line is right on top of the gray line. So essentially a normal speed of the marketplace. And as I was pointing out earlier, you can see that the purple line tends to follow the gray line. Here you had a surplus superheated marketplace. And right at the pandemic announcement, we had a super cool marketplace. And then the latter half of 2023, we had a super cool marketplace. And, yeah, I'm saying super cool. It was simply a cool marketplace, but we came out of a superheated marketplace. So a cool marketplace after that recent experience felt like a super cool marketplace. So here is your compared to typical, and you can see that we're down here right at typical, and you got a range of what typical is. You can see we were way hotter than normal right here. We went into the pandemic cooling off because you couldn't even show properties according to the health regulations. And then you can see the 2022 slowdown here. So you can see major slowdowns, but in general, the market tends to turn over at the same rate that it typically does for that time of the year. Here's marketing time, and this is on here for the consumers that don't like statisticians playing around with the data very much. So it's simply how long does it take 75% of the sellers to sell their property. Right now, that number is about 26 days. And that's exactly normal, as you can see. You can see that it had just been basically the last quarter, it had been above the gray line. And you could even argue that for the last 2 quarters, well, only about the last quarter and a half was it above the gray line. It basically sometime during second quarter, we slowed down very rapidly. We took longer to sell the property. So again, this is, 3 out of 4 sellers are taking this amount of time, which is 26 days or less to sell their properties to get that offer in. Here you can see this huge improvement. It's been generally improving, but this is the last week has been a huge improvement. You went from 10% slower to normal in just 1 week. So that's a pretty major improvement. And there's no holiday to explain that improvement. It's probably that the market normally slows down, and this year it's not slowing down. Here is the sellers that are taking the largest 10% price reduction. So this is sort of an abnormal look at the data. And here what I'm doing is simply taking the 10% of the sellers. So I'm ignoring 90% of the sellers. I'm looking at the 10% of the sellers that are taking the biggest price reductions and how big of a price reduction are they taking. And you can see it's at 87% of the ask price, which is a 13% price reduction. That's pretty significant. So 10% of the sellers are taking 13% off their original ask price. Normally that number's up here somewhere around 10.5%. So it's quite a bit bigger than normal, which is why you're down here close to the blue line. It's not as much as you could be. And you can see we have achieved that maximum number and exceeded that maximum number at times. But right now we're just bigger price reductions than normal. And here you can see the purple line is up in the blue and quite a bit higher than 100%. And the reason the gray line is below 100% is even in a hot marketplace, which is the normal, the sellers are taking a price reduction. So to put 0 price reduction in there would take a superheated market, which is why I put that in there. And it looks like I put that in at about a 5% price reduction, because this would be 90%. So yeah, it looks like about 5% price reduction. And this again is still only the 10% of the sellers that are taking the biggest price reduction. So we're not looking at all the sellers. We're only looking at that 10%. Now to get back into more normal analysis of the marketplace, we're looking at the average price reduction. But when you look at the average price reduction, it went from 13% that I was at 2 slides ago to here you're only 0.9%. So the typical and the actual are right at the same level, and 0.9% seems insignificant. And that's because a large percentage of the sellers are doing no price reductions whatsoever. So here you can see, and in fact, what that says is almost that 0.9% that we're at is the typical marketplace. I'm showing it as being a little cooler. I think this slide needs to be adjusted accordingly, but we'll worry about that later. Here is the frequency of the price reductions. So how many sellers are doing price reductions? So here you actually have fewer sellers taking price reductions. So you have the 10% of the sellers that are taking the biggest price reductions are taking larger than normal price reductions, but the number of sellers, the frequency of sellers taking those price reductions is actually slightly lower than normal at 16% instead of 17%. 1% may not sound like a lot, but when you're talking 16 versus 17%, that starts to become significant. Here is showing that fewer sellers are taking price reductions than typical. Typical would be up here at 100%, and right now you're a little bit below. You're about 95% of the level you'd expect. Here is overbidding. So now we're completely leaving the seller's aspect, and we're looking at what the buyers are doing. This is the buyer's competitiveness of the marketplace. And you can see that we're above normal. So buyers right now are coming in and overbidding, and this is the median. And so you can see instead of that 105.7%, if I remember, for the average price increase, your median is only 103%. And actually it looks like about 102.75. So 2.75% above the seller's ask price is the median overbid. So half the buyers are overbidding more than 2.75%, and half are overbidding less than 2.75%, even though the average is up there at almost 6%. Here you can see the amount of overbidding on the median level is higher than typical. Here's the frequency of overbidding. So frequency of overbidding is very close to normal and following the normal pattern. And that's somewhere right around 65% of the buyers are coming in with an offer over ask price. So that's just under 2/3 of the marketplace. So 2/3 of all offers are above the seller's ask price. Here's the frequency, and it's a little bit above. So you're about 102% of where you'd expect it to be. Here's the long-term appreciation. The blue thin diagonal upsloped line is sort of the freehand idea of appreciation. There are 2 real key takeaways on this slide. It's the huge run up in price and then this overshoot that we have in correction. I call it an upside down V or U. And then you have a regular V at the end of the year. Here's your regular V at the end of the year. Here's your upside down V. And we're actually below where I would expect prices to be based on the long-term appreciation. And in 2021 and 2022, we were above that level of appreciation. And the question is, are we going to have an upside down V from here? And I would actually anticipate it, yes. And, it's about a half a quarter away from starting, but, there's no way to know with certainty. And here I'm throwing the estimated payments, and this assumes the 30-year fixed rate for the national average. You can do better than that interest rate by going with adjustables or by having relationship banking or simply borrowing jumbo money, which is at a lower rate than the high balance conforming rates. Here is the distribution for days on marketplace. What we're doing here is we're starting off a year ago, which is blue dash dotted line here. Where we are now is the purple dotted dashed line. So the market is cooler since you're towards the worst year from where the hottest year. The current year is worse than a year ago, but we're starting off at this year ago level. We're going to be going at 4 or 5 weeks at a time, simulating a month at a time. And those are shown in dotted lines. You can see them here. Then when we get to 3 months, we shift over and we'll start looking at weekly data. And that's showed by the dashed lines. And then the second half of the dashed lines are solid lines for the recent weeks. So let's start in You can see the major climb, another major climb, and then the spring heat up of the marketplace. There's the peak for this graph. Now it's cooling down, and you can see basically the earlier time frame, and now we're going to be jumping into current weeks. So these are the last, whoop, there's the first 6 weeks ago, 5 weeks ago, 4. And so you're getting some bounce and some actual little bit of improvement. There was another big improvement. So we've had improvement from about 4 weeks ago. This line right here, the blue line up here is the worst line, and that would have been September 6th, which would have been 4 weeks ago. Now doing the same thing with ask price reductions. So you can see again, the purple line is below on the cool side of the blue line. So the market is cooler this year than it was last year. And again, we're starting last year at this level. We're going to be going to the dotted lines, which are the oldest lines. And then and there's the cool down, and here's the heat up. So there's the spring run up. There's the peak of the marketplace, and now you're starting to cool down. So the ask price reductions is very steep. And now you're basically weekly data, which is why it's dashed data instead of dotted data. And at 6 weeks, we go to solid data lines. And so there's your more recent weeks, 3 weeks ago, 2 weeks ago, 1 week ago, and the current week. From 1 week ago to the current week was a fairly significant improvement in the ask price reductions. So sellers are seeing the improvement out in the marketplace and reducing their prices less often and by smaller amounts. Now we're flipping over and looking at the buyer's overbidding. And not to sound like a broken record, but again, the purple line, the purple dotted dashed line, is on the cool side of the blue line. So the marketplace is cooler this year than it was last year. We're starting off on the blue line and going a year at a time, and you can see that the market slowed down from that time frame. There's the coolest. Now you improved. That's the peak of the marketplace for this year, and now you've cooled down, and now you're changing over to weekly data. And now you're on solid data, which is 6 weeks ago. And there basically has been very little movement. It's been bouncing for the last 6 weeks. And the way you read this is you can come down to the bottom here and pick whatever percentage of sellers you want. And basically right now, 40% of the sellers are receiving about 8% over their asking price. And that's how you read this table. So if you really want to be aggressive on an offer, you come out here and say that 10% of the buyers are overbidding about 17% above the seller's ask price. And of course, you'd want to be doing that on the individual micromarket area where you're doing your offers. Now what we're doing is we're comparing the 3 counties, Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the orange. And just real quickly, the orange to me looks like you're at basically the normal levels of inventory. Santa Clara County is definitely below where it normally is. Alameda County is approaching the normal levels. It's still down because it's normally up here somewhere around 1,500, and you're only at 1,250. So you're missing about 250 transactions. But if you look at Santa Clara County, it's normally somewhere around 1,300, and it's down here at 900. So it's missing 400 on a lower sample. So Santa Clara County is clearly missing the most inventory of the 3 counties. Offers accepted, Santa Clara and Alameda County are tied, and Santa Clara County had a shortage of inventory, so Santa Clara County is going to have a faster turnover rate than Alameda County. And if you look at San Mateo County, it's probably got a shortage of offers and normal inventory, so it's going to have a slower turnover rate than it normally does. Here's your days of unsold inventory, and we'll start off with San Mateo County. It's normally at the bottom of the pack until we hit the pandemic, and now it's in the middle of the pack. And that's an improvement because it had been the worst until recently. So clearly San Mateo County has slowed down a little bit compared to normal. Santa Clara County is accelerated because it's the fastest of the 3, and Alameda County is the slowest. So even though Alameda County has the slowest turnover rate, in a little bit, we'll see that it's got some of the highest overbidding, which doesn't really make a whole lot of sense. But I think it's got to do with the different micro market areas that we saw with appreciation. Here's time on the marketplace. As with turnover rate, Alameda County is the slowest. San Mateo County is in between at about 27 days, and the fastest is Santa Clara County at 22 days, just over 3 weeks. So 3/4 of the sellers in Santa Clara County are going to be selling their property in 22 days. Here's the magnitude of overbidding. I would call this a three-way tie, basically, very little difference. This is the seller's ask price reductions. Look at the huge improvement in San Mateo County. Sellers are starting to take significantly less price reductions in that county. They're sensing the improvement of the marketplace. Here's the frequency. The frequency in San Mateo County is reducing as well as the magnitude. The other two counties are doing the same thing, but at a lesser degree. Here's the average overbidding. So this is how much overbidding the buyers are doing. And here you can see Alameda County is in top position with 6.5% overbid, and San Mateo County and Santa Clara County are tied at basically somewhere around 5.5% overbidding. So Alameda County is outperforming by a whole percent, and that's 20% of the 5%, even though it's got the longer marketing time, which, I don't have an explanation of why that's happening, other than buyers in Alameda County are sensing a higher sense of competition. And I'd expect that competition to be in those areas that saw the highest appreciation versus in Alameda and Berkeley and Oakland. Here's the frequency of overbidding, basically a three-way tie at basically just under 2/3 of the buyers are going in over asking price. For a buyer, even though the market might be a little bit slower than it has been, buyers are still in general going in over the seller's ask price. Here's the appreciation. Santa Clara County as a whole has outperformed the other two counties. San Mateo County and Alameda County are basically tied. San Mateo County did this huge improvement, not this last week, but it looks like about 2 weeks ago, right after Labor Day. Here's the long-term pricing. I drew in the horizontal line so you can see that San Mateo County is above its 2023 pricing. Santa Clara County is above its 2023 pricing, and Alameda County is right at its 2023 pricing. That's on lot paper. This is the same information on regular paper for those that prefer. Here's the estimated payments. They're going to be in the same order because the formula I applied is the same. But in Alameda County, you're looking at $9,000 payments. In San Mateo County, you're looking at $14,000 payments for the median priced home. Now we're getting into the micro market areas, and I've done some changes on this. I brought the key up to the top. I also added in Silicon Valley so you can see what the valley as a whole is doing. I added in the individual counties. Here you can see Silicon Valley is at 99.9% of the inventory you'd expect. I mean, you can't get more at normal than that. You can see Santa Clara County is at 96%. Then we can see each one of the micro market areas in Santa Clara County goes from a low of 71%. So there's a significant shortage in the Cambrian, Campbell, Santa Clara, Willow Glen area. And there's actually a slight surplus in Cupertino and Sunnyvale, and a bigger surplus in South County at 109% of the inventory you'd expect. Coming down to San Mateo County, right at 100%, but it ranges from a low of 85% of the inventory you'd expect in the expensive areas to a surplus in Redwood City at 7% above. So you got it going on both sides of 100%. Alameda County, I do not have the micro market data, unfortunately, for the first 3 slides. Same concept with the offers. Here, it's very clear. Look at the blue just across the whole area. And you can see you have 85% of the offers you'd expect. Santa Clara County is at 87%. Coming down to San Mateo County, 89%. And coming down to Alameda County at 81.6%. But notice the fluctuation within each county where I have the micro market data. 88.9% in San Mateo County. It goes from a high of 103% to a low of 75%. There's quite a bit of variation in the county, and that's why it's important to look. In Santa Clara County, you go from a low of 73% to a high of 115%. I maintain that you look at the county-wide information does not paint the picture for the outlying areas. And they're not really outlying. The county really is not homogeneous. It varied fairly significantly. Days of unsold inventory, the speed of the marketplace, completely normal. There's only 2 areas that are not within the 12.5% range, and that's Redwood City at 40% slower than normal, and then Foster City at 25% faster than normal. Foster City is basically a very small area, so I'd almost ignore that and say that the area is absolutely normal except for Redwood City. And when you look at that, even though the range is 12.5% on each side of 100%, the range is basically from somewhere around 93% up to about 110%, and I would actually say 106. So the range is actually closer to normal than the graph would indicate. Here's your speed of the marketplace. This is just raw count. So even though we're having normal marketing times, the speed of the marketplace, the turnover rate is still fairly quick. When you sell out your entire inventory in 43 days, that's normal for Santa Clara County. San Mateo County is 43 days. Alameda County is 51. So all 3 counties are about normal, but here we have the individual data for Alameda County for the first time. And you can see you're going from a fast marketplace of only 28 days in Union City and Newark to a long time of 84 days in Oakland. There's no way you can put those things in a blender and come up with an understanding of what the market's doing, which is what countywide data does. And then the media is focused on Bay Area data, which is even worse. Here's your marketing time, which is the easy to understand concept. How long does it take to sell? Basically from 2 to 6 weeks is white in color. So a fair amount of the more affordable areas in Santa Clara County are white. Your more expensive areas are actually doing better with less than 21 days of marketing time. San Mateo County is on both sides. And then you come down to Alameda County and it's pretty balanced. While the average is here for me now, 33. That's why I added it. I didn't like to have to go, oh, it looks like about so-and-so. Here I actually have the data. It's 33 days with a long time of 51 days in Pleasanton, which is sort of interesting. So even though it takes 84 days to turn over the inventory in Oakland, 3/4 of the sellers are selling in only 46 days. Here's the seller's ask price adjustments. The blue is the larger areas of price reductions. So Santa Clara County is right with Silicon Valley at 0.9%. San Mateo County is at 0.8%. And Alameda County is doing the bigger price reductions at 1%. And if I had to guess what's going on in Alameda County is they're doing the bigger price reductions, and then buyers are coming in and overbidding on those larger price reductions. Here's the frequency of price reductions, and you can see it's very infrequent, which is why there's a lot of red on the map, which means basically less than 1 in 6 sellers are lowering their asking price. Here's the magnitude of overbidding. So now we're looking at buyers. So now you can start seeing the overbid range, and Silicon Valley is at 5.7%. Santa Clara County is 5.1%, but it goes from a low of, I guess it is a low of essentially exactly their ask price in South County to a high of 9.5%, almost 10% in Cupertino, Sunnyvale. So there's a 10% range within the county. You come down to San Mateo County and you're basically at 5%, but right off the bat, I'm seeing you're taking a 2% price reduction in the expensive areas. And then you jump down to Pacifica and you're getting a 9% price bump. So there's again a big range. And in Alameda County, 6% overall, 0.2% price reduction in overbid reduction in Pleasanton. And the high is Oakland. Actually, the high is Berkeley. But Oakland's got the second most overbidding in it, where it had 84 days of turnover time, days unsold inventory. Here's the frequency of overbidding, red up and down the graph overall. A lot of buyers are going in with their overbidding. You can see Silicon Valley is at 65%, Santa Clara County at 65%, come down to San Mateo County, it's at 63%, and Alameda County 64%. But again, the numbers vary from a low of 40% in Pleasanton to a high of 79% in Berkeley and Alameda cities. Here's the long-term appreciation. And this was really interesting too. It's the Alameda County, which we sort of talked about at the beginning. So overall, it's had a 70% price appreciation since 2015, but it's gone from a low of 38% in Oakland to a high of 93% in Fremont. Again, it's real important. You can see the blue is basically on the peninsula. The red is the inlying areas that used to be less desirable, and with remote working and more flexible work schedules, they're now more sought after because they're more affordable. Here's the sold price, and instead of following the median number only, which is in the middle number, I follow the 10%, the cheapest in an area and the most expensive as well. So you can see the price range in each area and sandwich it. Here's a summary of the overall tables. You can start over here with your monthly payment you want, the affordability you want, or the geographical area you want on the left-hand side. Read across and see the conditions. The dark yellow highlight are the sort of the leading indicators. This is a quasi leading indicator. It really doesn't, but it does some to degree. And the orange are lagging indicators, the dark being more important than the lighter one. Here's the actual numbers for those that want Santa Clara County, San Mateo County, and Alameda County, or Silicon Valley as a whole. You can come down and look at the metric you're interested in and get the actual raw numbers. This chart's up here to show that the current year we only sold 2130 homes this year, which is the 8th slowest out of the last 10 years. 2022 and 2023 were slower years, and we're the 22nd slowest year out of the last 25, which is sort of the more significant number. We've been talking about the Silicon Valley real estate market analytics for October the 5th. We will be going into the Greater Bay Area, which is 13 counties and 5 regions. I appreciate it if you would like each video you watch and subscribe once. If you'd like to look at a past episode, just go to the blue YouTube archive URL and you'll get there to the channel. Or you can type in the shorter green root URL and it will take you to the same place. To join us Saturday morning lives at 9 a.m., just enter in the green root URL in 2024. The passcode's here if you need it. The handout, 67-page PowerPoint presentation is posted. The green root URL plus H for handout 2024, 10 for October, 05 for today's date. If you want any specific past episode, the green root URL plus the year, month, date code. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is here for you. I represent buyers or sellers here in Silicon Valley. Again, I'd appreciate it if you'd like the video. Moving on to the Greater Bay Area. We've talked about Silicon Valley at length. We've added in the second region is the cities, San Francisco and Marin. The third is North Bay, Sonoma, Napa, Solano, and Contra Costa County. The fourth is the Central Valley, San Joaquin and Sacramento. And the fifth is Santa Cruz and Monterey, the Central Coast. Here's the data. We're looking at the active inventory. So you can see the active inventory for North Bay and Central Valley are relatively similar as they are historically, but they're down fairly dramatically. You know, roughly I'd pick some number up here, not quite 5,000, but above 4,500, and now you're only at 3,000. So they're missing a full third of their marketplace. Where Silicon Valley, I'd put the number closer at 3,000, and now you're at 2,600. So you're only missing 10% of the marketplace. So clearly the Central Valley and North Bay is missing a lot more inventory, a lot less buyer choice. Then you come down to the Central Coast and cities, they're also missing some inventory, but the magnitudes are much smaller, but percentages are probably similar. Here's the number of offers accepted. Even though Silicon Valley had less inventory, it's getting significantly more offers than either the Central Valley or the North Bay. Clearly, the turnover rate, the speed of the marketplace is going to be fastest in Silicon Valley. Here's your days of unsold inventory. And yes, Silicon Valley has the fastest turnover rate at just over 40 days, probably 41.5 days. Then you have a three-way tie with the cities, the Central Valley, and the North Bay at somewhere around 58 to 60 days to sell all your existing inventory. And the slowest region, the slowest turnover rate is the Santa Cruz, Monterey area with about 85 days to sell their inventory. This is actually marketing time. This is measured by looking at how long it takes 3/4 of the sellers to successfully sell their property. That is to get the offer in the door, not to close escrow. The slowest area is the Central Coast at 58 days, followed by the North Bay at 56 days. The Central Valley comes in third place at 43 days. Then San Francisco and Marin, the cities, comes in at 36 days. And the fastest, as I said earlier in the slide, Silicon Valley at 26 days, 3/4 of the sellers. So 3/4 of the sellers are selling their property in under 4 weeks in Silicon Valley. Looking at the ask price reductions, what we'll find is this is the average, and it's very small numbers that you're talking about, and that's because a large number of the sellers make no price adjustment at all. Silicon Valley is about 0.9% adjustment, and then going down to the slowest or the most reduced area is 2.6% for Central Coast, which is how much the sellers have reduced their own asking price before the offer comes in the door. Moving on to the sellers' frequencies. This is how common is the sellers. And in Silicon Valley, only 16% of the sellers reduce their price. That's 1 in 6 sellers reduce their price. In the cities area, it's 1 in 5 at 20%. In North Bay, it's 30%, which is 3 out of 10. And then in the Central Valley and in the Central Coast, it's 1 out of 3 at 33% of the sellers reducing their asking price. This is the overbid. So now we're flipping over and looking at what the buyers are doing. The cities is the most overbidding at somewhere just shy of, call it about 7.5%. The Silicon Valley is second at 5.5%. North Bay is third, all the way down at just 0.5%. And now you have the Central Valley, which is actually doing a price reduction of about 0.1%. And then the Central Coast is a full percent price reduction. Looking at the buyer overbidding, the buyers are coming in and still overbidding, even though the market has clearly slowed down a little bit. And in Silicon Valley, 2/3 of the buyers are overbidding. In the cities area, it's 60% of the buyers are overbidding. In the North Bay, it's down to 44%. In the Central Valley, it's at 40%. And even the Central Coast, where it's taking over 2 months for 3/4 of the sellers to sell, it's down at 36% of the sellers. So still more than 1/3 of the sellers are getting over their asking price. Here's your long-term appreciation, and the clear takeaway is the cities has the least amount of appreciation at 40%. The Central Valley has the most appreciation at 94%. Silicon Valley is at in second place at 83% appreciation. Central Coast is around 74%, and North Bay is in second to last place at 58% overbidding. Moving on to the median sold price, the cities now is back in the top, which is their long-term normal position with the highest price, followed by Silicon Valley. Central Coast is in the middle, North Bay, and the most affordable area is the Central Valley, where the typical home is about $570,000. Moving on to the monthly payments, this goes through a formula using the interest rate for the national average published by the Federal Reserve Bank, and assumes an 80% loan. You can do much better than that by doing an adjustable rate loan, by having relationship banking, or just even using jumbo money, which is cheaper than high balance conforming money. And these are in the same order as the price. So the cities has the highest monthly mortgage payment at $12,000. The Silicon Valley is going to be second at about $11,250. Then you have the Central Coast right around $8,000 a month. Then you come down to the North Bay at about $5,500, and the most affordable region is the Central Valley at about a $4,000 a month payment. Here are the actual numbers, so you can pick the actual county out of the 13. In addition to 13 counties, I do have Silicon Valley and the Bay Area. I include the Bay Area, even though I believe it's a garbage number, simply because the media talks about it so often. And then you have your metrics going across the top. You can look at whatever number is important for you. And with that, I'm open for any questions. Not seeing any unmuted mics. I'd appreciate a like, and see everybody next week. Take care. Bye for now.